We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Sam Lawrie. He's got a background in financial services, bullion, derivatives, and algorithmic trading. Sam, thanks for joining me again.
Thanks for having me, Tom. It's great to be back with you.
I'd like to start by getting your perspective on the market's reaction today to the little bit hotter than expected CPI numbers and how gold sold off. We're at the moment we're recording this, we're just below that $2,000 level. So I'd like to get your take on how the market perceives these numbers when they come out and the chain reaction that sets up.
Yeah, what a great place to start. So last night we saw some inflation data. Last night, my time, we saw some inflation data come out of the US, hotter than expected, like you've mentioned there. Gold and particularly silver took quite a drop on the back of that news. The DXY moved up substantially, so the US dollar strengthening on that. People talking about, well, there's the interest rate cuts that everybody's been waiting for are delayed. So they're still coming, but they're delayed. Fed people are still saying that they're going to cut this year. Market's pricing in around a 1% cut down to the 4% level. So that's something to be looking at there. But talking about the effect on the metals, I think it's quite poignant to think about the long-term implications of what's going on here. I mean, if they're talking about interest rates being held higher for longer or anything like that, then you've also got to look at the debt that's maturing this year. So around $10 trillion of the US national debt is maturing in 2024. So if they do keep rates at, 4.5%, then all of that debt rolls over at a much higher interest rate than what it was originally financed at. Mm-hmm. The markets, particularly the metals market, selling off on the back of, higher for longer. We can understand that higher interest rates being a headwind there for gold, as it's people think, oh, well, if I can get a higher interest rate on my savings, I'll keep it in the bank rather than buying gold. But the long-term picture is even uglier. The longer they hold rates high and the more debt that rolls over at said higher rates, it's just going to hurt them more and more on the interest repayments. So, yes, inflation's higher. We see metals sell off, which from the initial standpoint, you think that doesn't make sense. Metals are supposed to be a hedge against inflation. All of that's a US dollar move there. And then, you think about the bigger picture and you go, well, even if inflation's hotter and they hold rates, that's still not a bear case for gold here. So really interesting sell-off there. And something to think about as well with interest rate policy is interest rates have been high-ish, relatively speaking here, and the markets have continued to climb. Now, you look at the bank BFTP, now that's ending, they say, March, or rumours that end in March. And I think that's one of the reasons why the markets have continued to climb higher in the face of these higher for longer interest rates. And, the Fed talking hawkish here. We all know that they can't really play a Paul Volcker and raise them to 15% again, but they are talking hawkish. So it's very interesting. And then watching, Jerome Powell flip-flop on interest rates. I mean,
before we continue there, let's dig into that a little bit more. Why with the Bank Term Funding Program, what's the mechanism that you think of that ending makes the markets keep climbing higher?
So, well, I think ending the bank funding term program, I see that as an end in additional liquidity added to the system. So I think of it as a program that's added liquidity, which has allowed the markets to climb. And therefore, when you withdraw the program, you're withdrawing liquidity, which could turn markets the other way, stock markets in particular. And given the nosebleed level valuations we're seeing at the moment, I see the stock market is very prone to downside moves. Not to say that they'll happen immediately, but there's a lot of room to the downside if they were to move down. So that's my kind of thoughts with the BFTP is that it's held the markets up by providing liquidity. And if they do take it away in March, like the rumors say, then I think that could lead to some downside moves in the stock market.
Gotcha. And then just going back to your other point about, let's say, the comparison between the DXY and gold, it could necessarily be that, we're not actually seeing gold get sold off heavily. It could be just that kind of that comparison that the DXY has climbed so much, driving gold, that couple, I don't even think it was 2% lower over the day, right?
No, it was less than 2. Silver was more than 2, but gold was less than 2. And thinking about it as well, I mean, with rates at 4.5% and gold at just under $2,000 an ounce, I mean, a lot of gold bears out there have been saying that rates being as high as they are, gold should be a lot lower. And if you look at the treasury bonds, particularly the inflation, the TIPS, the inflation protected treasury bonds, they've been really badly sold off, and they're typically over the long term correlated to gold. So gold's held up a lot better than what you would compare it to, inflation protected treasury bonds. And it surprised a lot of gold bears in that way as well. So, us being gold bulls, we can sit here and say, gold should be a lot higher for X, Y, and Z reason. And, of course, I think we're absolutely right. But the other way of looking at it is all these gold bears, in my mind, have been kind of proven wrong. Everyone calling for, gold back to $1,000 an ounce or 1,500 or anything like that, quoting higher interest rates and all of that, it hasn't eventuated for them either. We've just been trading sideways, which is, kind of bored the bulls and bored the bears as well. So, yeah, it could be a lot worse, is I guess what I'm saying there with the gold price. It's holding up quite nicely in the large scheme of things. And when you look at it in Aussie dollars, I mean, it looks a lot better. We're at over 3,000 Aussie dollars an ounce. It had a great year last year, went up 13.5% in Aussie dollars. So, as a gold bug, you can't really be too upset with that, even in the face of higher interest rates, et cetera, et cetera. Yeah.
Yeah. I mean, you brought up a good point that this is just something that is, over the long run, something that is going to play out terribly. But when we have a move like this over the day, or let's say even this quarter, if we see gold stay below 2,000, in the grand scheme of things, that's going to look like an absolute blip on the, let's say, even the 5-year chart. And I think that perspective is really valuable to make sure that we keep in mind. But where you were heading before that was what you think caused the flip-flop from Jay Powell in the middle of December, just before the new year there, on his higher for longer path and that dovish speak that came out. Why do you think that he kind of changed his posture there?
What a question. So I remember back when he flipped back in December, and I think all gold bugs have been saying that they can't raise interest rates forever. Look at the debt, et cetera, et cetera. So it's not like it was an unexpected move in of itself, but the timing to me was quite unexpected. I mean, I didn't expect him to pivot that quickly to say, seemingly out of nowhere, hey guys, high for longer. Sorry, no more. We're going to cut rates. We're going to, bring it all lower for you. And of course, the market rallied, particularly the US stock market rallied really hard off that news. And then, now he's come out recently saying, sorry, guys, I was just joking. It's higher for longer again. And, of course, the stock market's still very elevated. But we're seeing, gold start to sell off on the idea of higher interest rates for longer. So it's what made him initially flip in December. We can all theorize. My theory is that he was watching the banking sector. I mean, we've seen New York Community Bank having issues there recently. They're the ones that bought out Signature. So, people are saying that the regional banking crisis is back. And in terms of my mind, what made Jerome flip was that he could see that coming. They've got much better data than I've got access to. So my thinking is they saw it coming further down the pipeline than we could. I mean, we watch the news as it happens. They've got much better data than we have.
Mm-hmm. Yeah, I think as you're explaining that to me, it occurs to me that obviously we're watching things happen in an election year. I think that this is going to be really telling for the Fed and especially for Jay Powell to really, in some ways, explain who he is and his path forward, and to really determine how political the Fed is going to be led to be in this election.
Yeah, it's funny you say that. I mean, here in Australia, just drawing a parallel for a second, talking about the politicization of our central bank. I mean, really recently, last week or two, we've seen the state premier of Queensland, with Brisbane, Gold Coast. We've seen their state premier come out and start pressuring for lower interest rates. For interest rate cuts from the RBA, from commercial banks. He's penned letters to commercial banks, pleading with them to lower interest rates for his constituents. And talking about the independence of central banks and setting policy based on the right policy, not what people would like. I mean, I see that as incredibly dangerous. If interest rates are lowered in the face of inflation being way above the inflation target, what does that tell the population? What does that tell investors? What does that tell the markets? And when you see politicians calling for this stuff, it worries me. It makes me think this guy's never read a book about hyperinflation before, which he probably hasn't. But again, it's worrying.
Yeah, but I mean, something that we'll get to a little bit later on is really understanding those, second and third order knock-on effects. These, lowering interest rates, of course, incentive-based politics, let's call it. Of course, you're going to think that that's the easiest, most expeditious solution to the problem right now. But again, if we step back and just look at it from the point of view of savers, who that ends up rewarding, it's a really unfortunate path to go down to, in some ways, penalize people that are trying to be responsible with their money, right?
Yep, 100%. I fully agree with that. I think of it from a self-interest perspective as well. This politician in particular, the Premier of Queensland, I believe he's got 4 investment properties, real estate. Now in Australia, real estate's almost a religion. We go crazy for real estate. We've had 40 years of up. That's very, very hard to argue with. But when the Premier comes out and starts talking about how we need to lower interest rates and he's sitting on 4 properties, you've got to really take that into consideration and say, yes, the incentives are skewed here towards lower interest rates. If most of the political class here in Australia are incentivized for lower rates, where do you think rates are going? And I think that's one of the big picture things to consider there is, in the very grand scheme of things, interest rate policy going forward over the next 10 years, yes, there's every reason for rates to go up. Inflation's high, it's going to be higher. In my mind, at least, all of that. But on the flip side, the whole system is incentivized for lower rates. So incentives versus reality, I choose incentives, which means that hyperinflation in my mind.
So, another market I think that has been in a lot of ways used politically is the oil market, and especially with the draining of the SPR last year. So how do you see that situation, and let's say how it played out and what the net results of that, in some ways, that political push to curb that portion of inflation, how that ended up working out?
Yeah, well, the oil market is fascinating to me. I mean, gold bugs, we love to talk about market manipulation in the metals markets, which is absolutely true. You look at the paper to silver ratio at the moment, it's close to 400 to 1. It's insane. But the oil market is also manipulated, and the oil market is the world's largest commodity market. So, when you look at the oil market, the draining of the SPR, the effect that had on price, bringing it down from $130 a barrel, down to below 80 at the moment. I see a lot of the moderation in inflation, at least in official inflation figures, that we've seen over the last year or so. I attribute a lot of it to the lower oil price there. So, market manipulation of the oil market has manipulated the entire economic picture. Talking about inflation's moderating, we stuck the soft landing. It's all good, guys. Don't worry. It all worked. Yes, inflation moderated because you dumped loads and loads and loads of oil on the market. So now that they're refilling the SPR again, and they've been refilling it at a much slower rate than they drained it, so as to not add market pressure. But the oil price is on the way back up again. It seems to be supported at the 200-week moving average, and seems to be, again, as I said, on the way up. So all of that downwards pressure from the selling has now become upwards pressure from the buying. So I'm very bullish oil. I think oil is going to have a great year. Particularly given all the drama we're seeing in the Middle East, the Houthi rebels, Iran at the moment. There's a lot going on there to talk about. So all of that is, of course, bullish for oil. Big picture though, bringing it back to it, we've seen a moderation in inflation largely due to this dumping of the SPR. And I now see that reversing, which means that inflation should run hotter for that reason, at least, as well as the reasons around shipping with the Middle East. The redirecting ships from the Red Sea across Africa. That's a much longer route, much more expensive. That adds to the costs for consumers in the West. In the same way that when COVID kicked off and all the ports were shut, that really added to our shipping costs there as well. So it's the same thing all over again for that reason as well. So all of these inflationary pressures, which we've seen show up in the inflation data last night, all of it leads to a bull case for precious metals, which are, again, hedges against inflation.
Mm-hmm. So how do you see China, reopening and the issues that they're having playing into that as well? From, we're talking about these demand side factors. That's obviously a massive market that we have to take into consideration.
Mm-hmm. Absolutely. It's 1.5 billion people, and it's the world's manufacturing hub. So, with China at the moment, their share market's selling off quite sharply. They've banned short selling from their large financial institutions. They're printing massive amounts of money and stimulating the economy. They're lowering their reserve ratio requirements for banks. So they're really pulling out all the stops to make sure that they make their landing as soft as possible there. Again, all of which is inflationary pressures particularly for the metals market. The Chinese love their gold, right? So, if they print all this money and hand it out willy-nilly, then, some of it's going to go into gold. And another, beyond just China, which is of course a massive driver for the market for oil, they love oil, they use a lot of oil, and they don't really produce much, is India. I also look at India going forward, and India is a huge country, over 1 billion people. It's not very industrialized. It's very agricultural. There's lots of villages which don't have, electricity or, many cars, or, it's got a long way to go in terms of industrialization, which I do see happening over the next 10 to 20 years. I think India will do really well. But that will lead to a huge increase in the demand for oil from a big picture perspective there. So, you've got both the China stimulus and India's industrialization being massive demand drivers for oil in general. So, for those reasons, combined with the ones I've already mentioned, again, I'm quite bullish on oil, which that feeds in second and third order consequences, that feeds into the commodity sector more broadly, and precious metals more specifically.
Mm-hmm. So then how about, the supply side factors there, Sam? Like, are there many constraints, just based on the war, or is that let's say, the main constraint at this point before, let's say, I guess we can break that apart in two parts. If you also think that we are facing a peak oil production situation as well.
Yeah, well, from the supply side perspective, I'd say that the Middle East is the largest thing to consider there. But I mean, even from a peak oil perspective, people have been talking about the Permian Basin in the US. The US at the moment is producing record amounts of oil, which is great. It's fantastic. But there's lots of talk as to when that will peak. So, fracking, obviously that really extended the US's oil production lifespan, or, really helped it hit those big numbers that it's doing now. But eventually the Permian Basin will peak in terms of production. There's all sorts of data as to when that'll occur. I don't have a view on the exact date or time that it will, but oil is a finite resource. We will eventually hit peak production, and that may have already occurred. So that's another thing to consider from the supply perspective. And even if you go back to the 2020 coronavirus panic, back when the oil price went negative, lots of oil wells were capped. They were shut down, and that means it's very, very, very hard or impossible to bring them back online again. So you've got supply constraints. We are at record production, but peak oil is coming in my mind. So again, you've got that on the supply side to consider as well.
So Sam, all of that considered, what ends up being your outlook on inflation? Going forward, obviously considering the cost of this raw cost input into the economy as a major, catalyst for inflation. Again, if we keep seeing oil price surging forward, does that mean inflation reflects that as well?
Yeah, I think inflation will get a lot worse moving forward. We've seen a moderation, much like the mid 1970s, where we saw inflation moderate. The Fed prematurely thought it had won the fight against inflation, and then of course we saw the later half of the 1970s come through. So I think we're seeing a similar thing today, where inflation's moderating because they've dumped the SPR. And then now they're refilling it. Inflation's on the way back up, as shown by the data last night. And I think that's only going to get worse and worse and worse. As higher oil prices have their second and third order consequences on the economy, increased price of logistics, moving things around, increased price of food because farmers use oil to produce their food. Everything requires oil. Anything that's got plastic in it, oil. It's everything. So as the oil price climbs, the price of almost everything else will climb as well, and that feeds on itself too. And something to consider there as well is that Western governments, at least here in Australia, there's lots of talk of assisting with inflation. We're having a cost of living crisis, and people are saying that the government needs to help by printing money out of thin air and handing it out to the people that need it.
Or the Inflation Reduction Act.
It's crazy, isn't it, when you think about it? And those sorts of policies are popular across the Western world. So all of those will be inflationary as well, and those sorts of policies will become more and more popular as inflation gets worse. So I see inflation feeding on itself, and then you combine as well the consideration that inflation, in my mind, isn't just a function of fundamentals. It's not just a function of currency creation and all that. It's also psychological. I've talked about inflation expectations in the past and the importance of inflation expectations for the precious metals markets. If you think that your dollar will be worth something tomorrow, you will not spend it today. If you think it will be worthless tomorrow, you're getting rid of it today. That's something that precious metals stackers can, understand deeply. But when you track that out to the general population, a hyperinflation. If you look at the Weimar hyperinflation in Germany, they started printing money in the First World War. They were seriously increasing their currency supply even before 1918, but it didn't really kick off until 1920, and that was because of the psychology of it. The fundamentals had been in place for years, but it's the psychology that changed. So that's again feeding into what I'm talking about here with inflation feeding on itself. It's not just the fundamentals, which are absolutely there. It's the psychology of it.
Mm-hmm. Sam, I want to go back to, a thought that was occurring to me as we're, talking about interest rates here and, really central bank policy. Do you have a sense of, if we end up getting all of the central banks acting in unison, let's say, or if basically the last central bank to start to loosen monetary policy ends up basically winning that fight, just from a, even a capital attractiveness standpoint?
Yeah, well, it's funny watching our Reserve Bank here in Australia, comparing that to the Federal Reserve. Our Reserve Bank here has kept rates lower than the Federal Reserve has raised them, and that's led to a weakening in the Aussie dollar. If you take that out across the world, I mean, the best performing fiat currency over the last 50 to 100 years is the Swiss franc. That's one of the only ones that's performed better than the US dollar, which is ironic considering how poor the US dollar's performed against gold. But yeah, you look at countries like that, countries that are known for fiscal conservatism, or at least relatively speaking, then their currencies have done quite well. I don't think that there's many countries around the world that are equipped to keep rates significantly higher than the Federal Reserve. I mean, even Switzerland has had issues in its banking sector, Credit Suisse going down, that sort of thing. So I don't see any one country out there, standing strong and being able to keep rates really, really high. I mean, people argue that here in Australia, we've got relatively low government debt to GDP ratios, particularly compared to countries like Japan or the US. So people are saying that, we're set to do a lot better. But I had this discussion a little while ago with someone where, if you look at Australia, we own 80 tons of gold, which sounds like a lot, but we've got 25 million people. So that only works out to be about 3 grams of gold per person. Now, the US is supposed to have over 4,000 tons of gold in the vaults. And that works out to be a higher amount of gold per person. So, yes, we've got less national debt to GDP than the US does, but we've also got a lot less gold per person than the US does. So there's all these considerations to be made. And that's one of the reasons that Swiss currency has done so well, is because their gold holdings per person are very, very high. So yeah, the big picture there.
Mm-hmm. Yeah, it's an interesting equation to think about and to try to understand as well, for example, with the US not marking its gold holdings to market, right? They only hold it at, I believe it's something like $46 an ounce on their books right now. So those dynamics always, you have to try and kind of see through the smokescreen or the gray fog of economic manipulation to try to understand why they do things like that, right?
Absolutely. And something as well to consider about central banks and, gold revaluations and all of that. I mean, we saw that central bank in, I think it was the Netherlands, a year or so ago, that came out and talked about, if we were facing the prospect of a bank failure at the central bank level, we just revalue our gold. That was a sneaky little comment that I think a lot of gold bugs picked up on there. But even when you consider that, going back to the US for a second, 4,000 tons, I think people, not so in the gold space, but more broadly, should really learn about central bank gold leasing. It was something that I was briefly taught about at uni. It was one of the only things they taught me about gold at university. And I think people are really underestimating the importance of that. If here in Australia, our Reserve Bank publishes data on our central bank gold leasing, that they've leased up to, I believe, almost 100% of our gold at certain points. And if 100% of your gold is on lease, the physical bars aren't there, you've leased them out, you've got a paper contract that says, we'll give them back, and there is a revaluation event, do you revalue it to the gold that you're supposed to have, or do you revalue it to the gold that you do have? Mm-hmm. Again, something to consider.
Yeah, because I mean, if we look at let's say, the lead that the US took when Russia went into Ukraine and they seized the assets of Russia that were in the US, there are any number of justifications for, let's say, keeping other leased gold reserves, right?
Yep. And, counterparty risk, we all think about it from a individual perspective of, I've got money in the bank, I have to trust them as a counterparty. But from a sovereign nation perspective, again, I'll use Australia as an example here. I'm an Australian. Our Reserve Bank holds 99.9% of our national gold at the Bank of London. or in London at the Bank of England. So you look at that and you go, well, if there was this event where the London Metals Exchange needs a bailout from the Bank of England, if you think that the LME or isn't good for the paper contracts it has outstanding, which I don't think it is, then the question becomes, in this scenario of the house of cards collapses, whose gold is that really? Who does it go for? What is it used for? And if the Bank of England were to take it and use it to back, all these paper contracts they've got outstanding, then Australia has no gold. We've got 1 or 2 ounces stored in Sydney for a country of 25 million people. It's.
And you know what the crazy part about that is, that doesn't seem that far-fetched to imagine, right? If Australia has a problem and London has a problem, that means very likely there's more than just Australia and London that have problems, right? So if there is, this daisy chain of leasing or paper ownership of one asset that is at a reserve ratio of 10 to 1, let's say, that asset runs out real fast.
And I look at it as well, and there's no wisdom in the central bank thinking around gold. I mean, I remember back at university when they taught me about central bank gold leasing, they said, oh, we've got this great idea, we run these big government deficits, we've got all this gold sitting in the vaults doing nothing, let's lease it out, get some income, bring us closer to break even on the budget. And, I can understand all that. It's I wouldn't call it sound logic, but it is logic. And, there's a complete lack of wisdom, bigger picture thinking, etc., that goes along with that. And that's what really worries me, is that nobody is, well, at least nobody within the system is really thinking about the things that we are. And, there's storm clouds on the horizon. So, yeah, it makes you worried for the future of your country.
Mm-hmm. Well, at least you guys still have gold. Canada sold all of their gold, so we're in a much worse position from that respect.
Yeah, I've got to say, Canada's central bank seems maybe even more clueless than our central bank. Although you guys do have your beautiful gold windows for your central bank, gold in the windows. That's pretty cool. But yeah, you did. Australia, we sold a lot of our gold back in the 90s. The UK sold off loads of their gold back in the late 90s, early 2000s there, of course, close to the market bottom, as government and central bankers can only do, is sell market bottoms. But yeah, it's really worrying. No one in the Reserve Bank of Canada seems to care that inflation's really high, and other central banks around the world are stacking gold like crazy. Sometimes I wonder what the central bankers are thinking when they see that. Do they think, oh no, we're above that, we're special, our economy could never fail, our currency could never fail? If so, that kind of hubris is worrying.
Mm-hmm. Absolutely. So Sam, how does all of this, let's say, play into the market value that we're seeing in the US? The low interest rate environment, to me, that we've seen over the last 40 years, as I was talking to Dave Kranzler yesterday morning, this has just really driven everybody up and up and up the risk ladder to try and find some yield. So do you think that ends up being, this concentration that we've seen? It has just driven this momentum chasing behavior and everybody into this small concentration of stocks.
Absolutely. You look at the US stock market at the moment, most of the gains there are driven by the Magnificent Seven, the Facebook, Google, Microsoft, etc. I mean, if you look at NVIDIA at the moment, that share price chart just looks insane, absolutely insane. So, I look at it and I think, there's massive concentration in names. All of this capital's flowing to, companies are doing buybacks, huge corporate debt loads, and, share price keeps climbing higher in the face of that. And, we're looking at jobs numbers that are getting weaker. There's all this potential to the downside, but the market doesn't seem to be pricing any of it in, at least in the Magnificent Seven. But then you look at the small caps, and they seem to be lagging the rest of the market. It's not a fully fledged bull market, in that only the Magnificent Seven seem to be adding most of the gains here. So it's a really weird stock market. The PE ratios are absolutely insane on some of these companies, particularly stocks like Nvidia. And this is in the face of layoffs. We're seeing layoffs across the whole tech sector, while their stock prices are just going parabolic, and it begs belief. You look at it. I never thought I'd see the stock market do this. It just seems like fundamentals don't even matter anymore. It's just follow the money. And I look at it and I think this can't end well. When fundamentals no longer matter, you're obviously in bubble territory. And last night we saw this inflation data come in hot. We saw the US stock market drop. I mean, the Nasdaq dropped almost 2%. So yeah, there's a lot of room to the downside here, as I guess what I'm saying there.
So what in turn do you end up watching, let's say, coming up for this year, the next couple of weeks? Are you concerned about the banking sector, treasury auctions? What do you have your eye on?
Yeah, so there's a few things to be watching. So treasury auctions is one. It's not the closest thing I'm watching, but I'm definitely watching it. There's been a lot of weakness in treasury auctions, and this year we've got, as I said, almost $10 trillion of debt maturing. Therefore, it needs to be rolled over, and those treasuries need to be sold to a willing and happy buyer. How that plays out will be very interesting. Whether the free or the private market can buy up all that debt, or whether the Federal Reserve's got to hop in, print some money, and buy some of that debt up as well. If that latter scenario were to happen, again, incredibly inflationary there. Monetizing the debt almost. So yeah, there's that to consider. US banks showing weakness. So we talked about New York Community Bank. People saying that the regional banking crisis is back on. I mean, at the end of the day, the initial reason that Signature and Silicon Valley Bank went down, climbing interest rates, they've locked in all these assets at very low prices. Their liabilities are climbing as they've got to pay their depositors more and more. All those problems, they still exist. The US banking system has still got rates much higher than they've been over the last 5 years. There's still insane unrealized losses on these banks' balance sheets. The BFTP program is really just papered over the top of it. It's allowed them to continue functioning even in the face of their massive unrealized losses. So, all the reasons that the original regional banking crisis happened are still there in the background. And, talking about the BFTP program being withdrawn in potentially March, they're saying, well, if BFTP is the reason that the regional banking crisis went away, then the removal of BFTP could very well be the reason that the regional banking crisis comes back. So, yeah, that's a big worry, and particularly for the bullion space. I remember when that Signature and Silicon Valley Bank stuff happened, there were lines around the block for the bullion dealers here in Melbourne. It was just insane. When people start to worry about the safety of their funds in a bank account, in a financial institution, that is incredibly dangerous for banks. And, it's a very worrying time for banks. I wouldn't want to be a banker right now.
Mm-hmm. That's actually something I wanted to get your take on. Since you guys have been operating Adams Bullion, have you seen any trends, whether that is, large buying or even selling for that matter, selling by consumers trying to get some money out of their precious metals?
Yeah, so broadly speaking, I mean, in the precious metals markets or on the bullion industry, so January is generally quite a slow month. There's a lot of financial hangovers from Christmas. People are generally low on fiat. There's a bit of selling as people need to fund their holidays and all their purchases, etc. So there's been a little bit of selling over the last month, but there's also been a lot of buying. A lot of first-time buyers coming in. A lot of people that are, again, looking at inflation, looking at interest rates. They're going, well, if they take interest rates lower with inflation high, what does that mean? So, there is a lot of buying. Particularly, November and December were very big months. November was a huge month for us. So, there is a lot of interest in the space, particularly for newcomers. And, even existing investors, the price charts over the last couple of years, silver's just moved sideways. Gold and Aussie dollars has moved up, which is great, but gold and US has moved sideways as well. So, existing stackers, they've built their positions, maybe they're adding to them slowly over time. But no, we've seen a lot of interest from new buyers coming in, which is good to see. It's good to see that people are waking up to the risks that we all face, and are doing something to prepare themselves for it. So yeah, and another trend I've been seeing is people are mostly interested in silver. I mean, with the gold to silver ratio where it is at the moment, it reached 90-1 the other day. It makes a lot of sense for people to be piling into silver more so than gold. I mean, there's still a lot of interest in gold, don't get me wrong. But even just the other day, I had a client come in and, she'd originally bought gold and silver with me, 70-30, 70% silver, 30% gold. And then she brought her gold in recently and she goes, I want to swap this over for silver. I think, silver's going to do a lot better. So yeah, we've seen a trend towards silver, and lots of new buyers, which is, again, very promising.
Mhm. And how about on your sourcing side? Like, have you seen a variation in premiums that you guys are having to pay on the wholesale side?
Not necessarily too much variation in premiums. I would say that availability has been spotty. So, we've had to wait up to 3 weeks for silver kilo bars. At the moment, it's about a week or two wait from our suppliers there, but those wait times have blown out, particularly in the November, December time. It was, the industry was very busy. But no, from a premiums perspective, it's been pretty stable. So yeah, more so availability. Yeah.
Excellent. Well, that's great, Sam. I think that's a good place to kind of wrap up today's conversation, unless you have anything else you'd like to leave our listeners with for today.
No, that's all from me. But yeah, great chat with you as always, Tom, and looking forward to speaking with you again in the future.
Absolutely. And of course, for anybody that wants to know more about Sam or their business, all available at adamsbullion.com and on Twitter as well at Adams Bullion. Sam, thanks so much for your time.
Pleasure, Tom, and thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.